Hello class, welcome to the chapter 7 handout answer video. And hopefully you watched the lecture video and you're starting to get a grasp on this depreciation and disposal of assets and revenue, capital expenditures, and some cost stuff. So let me get my screen shared and let's get right into this handout. There, we're going to start. Borgs Incorporated recently purchased land for the construction of its new manufacturing facility and incurred the following costs. Determine the cost of the land. All right. So we gotta think back to that slide where it tells us what is in the land here. Well, $125,000, the purchase price, that's definitely part of the land. The interest charges, yes. Commissions, yes. Delinquently property taxes, yes. Closing costs, yes. And the clearing and the grading of the land, that's getting it ready for use, that is also part of the land. So we're going to find out here, everything is considered part of the land that was given here. So we get the cost of the land to be $153,100. So if we were going to journal it, our land would be our debit. Assuming everything was paid in cash. Whoops. That's what a journal would look like with our date here. Okay, debit land for $153,100 and credit our cash. Right, Irons Delivery Incorporated purchased a new truck for $45,000. The truck is expected to have a $30,000 residual value, a 5-year useful life. Or they also expect 160,000 miles of the truck and given what it was driven. Okay. So depreciation. The three things we need. Cost equals 45,000. Residual equals 3,000. Its useful life is 5 years or 160,000 miles. So now we put out all the information we need from this question. To calculate the depreciation expense using the straight line, we have our cost minus residual divided by its useful life. So we have 42,000, which is the $45,000 cost minus the $3,000 residual divided by 5. So our depreciation expense under the straight line method is $8,400 per year. So that is for both 2023 and 2024. It also says to determine the book value of the truck after 2 years. Okay, so our book value would be our cost minus our accumulated depreciation. And after 2 years of doing the straight line method, it's going to be $8,400. So 28,200. That is our book value. For B, under the double declining method, first we need to find our rate. So we have 1 divided by 5 equals 20% times 2. All right, so once we have our rate, we find out we're going to depreciate at 40%. For the double declining, we do not worry about the residual value. We're more concerned about the book value. So in year 1, the book value is $45,000 because it has no accumulated depreciation. So we have an $18,000 depreciation expense in 2023. In 2024, our new book value becomes $27,000. That is the $45,000 cost minus the accumulated depreciation of $18,000. We multiply that by the 40%, we get 10,800 depreciation expense for 2024. Our book value now at this point in time, cost minus accumulated depreciation, which is 18,800. It's just a book value of 26,200 after 2 years using the double declining method. So here's our depreciation expense for each year. Okay, for the units of production, first we have to find out how much per unit we're going to take off. So that is our cost minus residual divided by usage. So we have 42,000 divided by 160,000 miles. So that was our cost of 45 minus the residual value of 3,000 divided by our useful life under the units of production, or 160,000 miles. So we get 0.2625 per mile. So in 2023, we take our 0.2625, multiply it by its actual miles, which was 40,000. Number 24. We take the 0.2625 multiplied by the actual miles driven. This time it was 36,000. So we get our depreciation expense for those 2 years as that. Book value again is the 45,000 minus the accumulated depreciation. The book value is what it's listed on the balance sheet as. So as you can see here, the depreciation methods can make a big difference on what your depreciation expense is here per year. As you can see here, under A, it's 8,400 per year. Under B, it's 1810. Next one, it'll be closer to 8,400, maybe right on it, a little bit less. Then the next 2 years are going to be below 8,400. And then our units of production will probably give us the most accurate matching description there. but it makes a big difference in our book value, and that is what gets reported on the balance sheet as an asset in the operating section. So you see, you can make a big deal, influence users' decisions. That's why depreciation method how they do it must be disclosed. All right, next part of this handout. Listed below are several transactions. Classify each as a revenue, capital expenditure, or neither. So if we paid $80 cash to replace a minor part of an air conditioning system, that is going to be a revenue expenditure, meaning it gets expensed immediately. When we did the work, we make an expense on our income statement because it's not going to do anything to its efficiency or productivity. Paid $40,000 to fix structural damage to a building. We're going to call that a capital expenditure because that probably just extended that building's useful life because we took something that was, the foundations was falling apart. So we fixed it. Okay. And therefore we probably extend the useful life by at least 5 years, maybe or so. Paid $8,000 for monthly salaries. That is neither, has nothing to do with property, plant, and expenses. That is an operating expense. Paid $12,000 to replace manual cutting machine with a computer controlled machine. Okay, I'm going to call that a capital expenditure. Okay, because what it sounds like here, the way I'm reading it, is that we're getting a whole new machine. So we're just going out and purchasing a computer controlled cutting machine. Okay, and replacing the manual cutting machine. So the actual buying of the machine is a capital expenditure. And then paid $1,000 to the annual painting of the building as a revenue expenditure. The painting of the building is going to make it look nice, but it's not going to make it last longer or more efficient. Okay. And what I want you to remember there, capital expenditures do not get expensed. They get put as an asset on the balance sheet and we'll take them off through depreciation. Whereas revenue expenditures are expensed immediately as they are incurred. All right, so Jolie Company owns equipment with a cost of $85,500 and accumulated depreciation of $76,200. Prepare the journal entry to record the disposal. Okay, I'm not going to pull out my journal sheet here. Just going to pretend that I have it on here. Okay, if you go on and you do accounting in another school, they're probably not going to give you a journal sheet. They're just going to write them, have you write them on paper, write them on the whiteboard, frog board like this, kind of how I'm doing it here. Okay, so we sold the equipment on April 9th, and we assuming what we sold it for here in cash. The first thing we would need to do is update our depreciation expense, but that information is not given to us. But so we have to assume that the costs and the accumulated depreciation are up to date. And then we go through and make our journal entry. First, we're going to debit cash because we received cash. So on A, we received $11,200 in cash. Step 2 is to take the equipment off. Okay, I'm going to skip a line because I know I need something in there, but to take my equipment off, I need to make a credit entry because it was normally on the books as a debit. I take it off at its cost because that's what I put it on as because of the cost principle. I also need to remove the accumulated depreciation. Okay, and the accumulated depreciation is $76,200. Okay. And now I do some math here and I see that on my left side of the equation, I have $87,400. On the right side, I have $85,500, meaning I need to put $1,900 as a credit entry. That will be considered a gain on sale of PP&E, a credit entry for $1,900 in order to make my equation balance out. Remember when I said when you're making that balancing entry, if it is a credit there, you're going to have a gain. If it's a debit, you're going to have a loss. So if we look at the second one, we have cash, $7,900 cash received. The accumulated depreciation still has to come off at 76,200. You take the equipment off the books again at 85,500. Now you see if we add up the left side, we only have 84,100. So in order to make this balance out, we need to put 1,400 more on the debit side to make our journal entry balance. And if we have to make a left side entry, then it is a loss on sale of PP&E instead of a gain. Okay, and you can also calculate it like this. Cash minus book value equals your gain or loss. So here we had 11,200 minus the book value of 85,500 minus 76,200. So minus 9,300, that would have been our book value. $1,900 positive, so 1,900 gain. And you can do the same thing out with part B. So there's a couple ways you can calculate the gain there. I like throwing it just into the journal entries. It makes easier sense to me because I know I debit my cash flow we received, remove the equipment, remove the depreciation, and then just plug in the difference. All right. So hopefully that gets you through chapter 7. If you have any questions, do not hesitate to reach out to me. And once again, keep up the amazing work. I'm very happy with all of you.